As of 11:26 a.m. Eastern Time, Navitas Semiconductor, ticker NVTS, is trading at $9.96 per share. That is a significant drop, down 50 cents on the day, or about 4.78%. The stock gapped down at the open and has been sliding since, carving out a session low of $9.86 on exceptionally heavy volume that is already challenging its daily average. This isn't a quiet drift lower. This is a high-volume, high-conviction move, and it's happening just 2 days after the company reported its third-quarter earnings. The immediate reaction you might be having, seeing a stock that's up over 400% in the last year suddenly get hit this hard, is confusion. The expectation, the story that has been driving this name, is all about artificial intelligence, data centers, and a major partnership with Nvidia stock. That is the narrative that has pulled in a massive number of retail traders, many executing their first online investment on platforms like the Robinhood app or using SoFi Invest. The belief was that Navitas, with its next-generation gallium nitride and silicon carbide technology, was the key to unlocking the power efficiency needed for the AI build-out. But here is the reality, and it's what the market is processing today. That AI-driven future, while perhaps still intact, is proving to be very, very far away, while the company's current business is in a state of collapse. The Q3 2025 earnings report, which landed on November 3rd, was the moment this glowing expectation slammed into a brutal wall of numbers. Navitas reported revenue of just $10.1 million. That figure not only missed analyst expectations of nearly $11 million, but it represents a stunning 53% decline from the $21.7 million they generated in the same quarter last year. Worse, earnings per share came in at a loss of 9 cents, missing the 5-cent loss that was forecasted. But the part of the report that is causing this sell-off today, the data point that has institutional desks at places like Fidelity and managers of Schwab Intelligent Portfolios recalculating their models, was the guidance. For the fourth quarter, Navitas management guided revenue to a mere $7 million, plus or minus $250,000. This is an absolute disaster for a stock that, until this week, was priced for perfection and exponential growth. Analysts were looking for something closer to $10 million or $11 million. This $7 million projection signifies a business that is not just slowing down, but actively shrinking and shrinking fast. Immediately following this news, the analyst community, which had been chasing the stock higher, reversed course. Rosenblatt, for example, downgraded the stock from a buy to a neutral. They didn't just change their opinion, they completely altered their framework, highlighting the extreme valuation disconnect. When you have a stock that has run up 416% in a year, as Navitas has, it is priced for flawless execution. It is priced as if the AI data center revenue is already flowing in. The reality is that the stock was trading at a forward price-to-sales multiple north of 33, while the rest of the semiconductor industry averages around 8 or 9. That is a valuation you usually reserve for a company like Nvidia stock itself, a company with dominant market share and gushing profits, not a company guiding for $7 million in quarterly revenue. This is the core tension. The market expected a high-growth AI supplier. The reality it got was a shrinking, unprofitable hardware company in the middle of a painful transition. Many investors who bought in on the hype, perhaps using investment help tools on investing sites, or just following the momentum, are now facing a difficult choice. This kind of volatility is where automated platforms like a Schwab Intelligent Portfolio are designed to avoid emotional decisions. But for the self-investing crowd on Robinhood or SoFi Invest, this drop is a severe test of conviction. So what is the company's explanation for this? This is where the story gets complex and where the bull case makes its last stand. The new CEO, Chris Alexandro, is calling this a strategic transformation. He is essentially describing the company in two parts, Navitas 1.0 and Navitas 2.0. The Navitas 1.0 business is the legacy mobile and consumer charger market, primarily in China. This is the business that is collapsing. Management claims they are intentionally exiting this low-margin, tariff-exposed business to free up resources. This, they say, is the reason for the revenue implosion. The future, the Navitas 2.0 vision, is all in on high-power markets, AI data centers, electric vehicles, and industrial applications. This is where the Nvidia stock partnership fits in. Navitas is working with them on the 800-volt architecture for next-generation AI systems, a market they believe could be worth $2.6 billion by 2030. They are also moving production from 6 to 8-inch wafers, which should lower costs and increase output for these more advanced chips. The bulls, who are perhaps adding to their positions today through their Fidelity brokerage account or the Interactive Brokers trading platform, are betting that this $7 million Q4 guidance is the absolute bottom, the reset quarter. They hear strategic shift and see a company cleaning house before the real growth begins in 2026 and 2027. The bears, however, hear something very different. They hear a company that simply lost its core market and is now hoping a new one materializes years down the line. To them, the Navitas 2.0 story sounds like an excuse for a catastrophic failure in the Navitas 1.0 business. They look at the $151 million in cash the company has, with no debt, and see a ticking clock. How much of that cash will they burn through before this AI revenue actually shows up? Management has been clear. 2026 is the transition year, with significant AI contributions not expected until 2027. That is an eternity in the semiconductor world. A lot can go wrong in that time. Competing technologies could emerge, or larger players like Texas Instruments or ON Semiconductor could muscle into their space. When you're trading a stock on a Fidelity trading platform or the Robinhood app, a story that's 2 years away from even starting is a very difficult investment to hold, especially when the current numbers are this bad. This is where online investing becomes a psychological battle. The 400% run-up was fueled by expectation. Today's 5% daily drop, on top of yesterday's 10% drop, is the reality of financial gravity taking hold. Let's look at the institutional and technical side. The institutional ownership data from before this earnings report showed strong support. Funds like Vanguard and BlackRock had significant positions, likely held within Fidelity mutual funds or Fidelity ETFs that track the small cap or tech sectors. But we are now in a period of reassessment. We are seeing massive volume on the Interactive Brokers platform and other professional-grade systems, which suggests institutions are unwinding their positions. The stock has decisively broken below its 50-day moving average and is now in a technical no-man's land. The question for anyone holding this in their individual brokerage account or even a Fidelity IRA is whether to trust the long-term Navitas 2.0 story or respect the catastrophic breakdown in the current financials. This isn't a stock like Apple stock or Tesla stock, which have massive, established businesses to lean on. This is a speculative growth play, and the growth just vanished. What do you, the person watching, think about this situation? Comment below with your thoughts on this Navitas 2.0 pivot. Do you believe the AI data center story, or is this $7 million guidance a red flag you just can't ignore? This is a crucial moment for the company. They have a new CEO, a new strategy, and a stock price that is in free fall as it disconnects from the AI hype. The company that specialized in gallium nitride power ICs and silicon carbide technology was supposed to be the future. They shipped over 300 million GaN units, proving their reliability. Their acquisition of GeneCivic gave them the high-voltage silicon carbide technology needed for the energy grid transformation. All these pieces fit the narrative. The partnership with Nvidia to support 800-volt data centers was the final confirmation, the link that connected Navitas directly to the most powerful trend in the market. Traders using SoFi active investing tools and Robinhood stock trading accounts piled in, betting that this was the next great semiconductor story. The reality, as we are seeing on the charts today, is that this transformation is incredibly risky. Shifting from a high-volume, low-margin mobile business to a low-volume, high-complexity data center and industrial business is not easy. It requires different sales channels, different support structures, and, most importantly, patience. The market, especially the part of the market that uses SoFi stocks and Robinhood investments for quick trades, does not have patience.